Recently, Vanguard came out with a research report that quietly predicts that most long-term investors are going to be off track for their financial goals. In today's video, we are going to talk about the report. We're going to talk about some important numbers that you should understand. And then most importantly, we're going to talk about some practical things that you can do looking forward that once you look at this, if you see, I think this report might be speaking to me as far as being off track, some things that you can do to get on track. Okay, so let's get started. So here's the report from Vanguard. Now at first look, it doesn't say anything about being on track or off track. It just talks about its 2025 private equity market outlook. Now, when we're investing in equities or stocks, we're investing in companies. You can either choose to invest in public companies. You can choose to invest in private companies. Vanguard has been around a long time, primarily with ways to let individual investors invest in public companies. Now, private companies are also an option for many investors. And what Vanguard's talking about is, okay, how do the expected returns of private markets look compared to public markets? So let's look specifically here and go to this chart. Now, this is based on Vanguard's 10-year annualized forecast. In other words, the expected rate of return for these asset classes annually for the next 10 years. Now, what you see here is if we look at our global public equity, so that's public stocks around the world, you can see an average expected rate of return of around 5.4, but this is a range. And so it could be as low as 3% per year for 10 years, as high as 7.9% per year for 10 years. And that's global public equities. So that's equities all around the world, which, okay, 5.4%, there's a range, that makes sense. What about global private equity? So rather than investing in the public companies traded around the world, we're investing in the private companies that are all around the world. Well, the average rate of return is expected to be around 8.9. The lower range is a little under 6, and the upper range is a little under 12%. Now, if you look at the volatility or the ups and downs to be expected when you're investing in either of these, the private companies are going to historically be more volatile because they're smaller companies. Okay, so private equity has an expected higher rate of return than global public equities. So what? Is this news, and what does this have to do with me being on track or off track for my financial goals? Let's dig in a little bit deeper in this report and talk about a chart that I think is going to be relevant for most. So this here is going to look at, again, these 10-year return projections, so the average return projection, and it's going to break it down a little bit. It's going to look at U.S. equities. It's going to look at international equities, so U.S. publicly traded stocks, international publicly traded stocks, global, so the combination of both, and then private equity. And what we can see here are these returns. We've got a little under 4% for U.S. equities. International is around 8. If you blend them together, you get around 5.4. Private equities at 8.9. So while we discussed a range of returns between public equities and private equities, this is using the average. Which, okay, again, what does this have to do with me being on track or off track for my returns? Well, very quietly, without making much of it, Vanguard puts this second line in here. Let me read it to you. It's the probability of meeting a 6% or higher return target. Okay, what does that mean? It means if you invest in this asset class, what is the likelihood that you will achieve more than 6% annual for the next 10 years? Okay, and if you look and we look, what do these numbers say? Okay, U.S. equities, 31% chance we will receive higher than a 6% rate of return. All the way over to private equities, it's a higher rate, right? So we're going to have about a 74% chance of achieving a 6% higher rate of return. Okay? Now, while this might just look like a bunch of numbers, let's talk about the practical implications for long-term investors or those nearing or in retirement. When you're building your financial plan, the financial plan that you look at with your advisor, what is the rate of return that you are assuming you need to achieve your goals? Now, I don't know what it is. It could be high, it could be low. We could just use this number that Vanguard used at around 6%, which I would say it's not a high target, it's not a low target. Let's call it a mid-range target of a 6% rate of return in your financial plan. If Vanguard were to restate this research report that looks like it's just talking about private equity, another way they could say their findings is if you are an investor and if you are planning to achieve 6% or higher for the next 10 years, and you're invested in U.S. public equities, which is what most U.S. investors are invested in, your likelihood of success is around 30%. So, in other words, your chance of failure is around 70% if your goal is to achieve a higher than 6% rate of return over a 10-year period of time annually. Now, for many, they look at the returns over the last 10 or 15 years in the S&P 500, and that seems like a very easy hurdle to get 6+% rate of return. Well, one of the reasons that Vanguard's assumptions, as well as many other firms' capital assumptions or market assumptions moving forward, is the S&P 500 or U.S. markets have a lower expected rate of return because they've done so well. And they've gotten really expensive relative to the rest of the world. And so Vanguard's nice 10-page report that looks like it's really about private equity returns, which they're expected to have a higher rate of return than U.S. equities. Great. But the real thing to be looking at is the box that shows the likelihood of success if you have a financial plan that says 6% or greater is around 30% if you're just investing in U.S. equities. That is not a high likelihood of success. Okay, so what can we do about it? Well, this is talking about U.S. equities having the expected rate of return of not great, but it also looks at international, which has a much higher expected rate of return. And it looks at private equity, which has a much higher expected rate of return. And so go back to your financial plan and talk with your advisor and say, okay, if I'm primarily in U.S. stocks and my expected rate of return or the target rate of return I need to hit my goals is X, 6% plus or minus, how are we going to do that? How can we diversify the portfolio to asset classes that have a higher expected rate of return so that I can stay on track to achieve my goals? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.